Hey guys, are you tired of banging your head against the wall because your multifamily numbers just don't work, or the bank keeps telling you you need 50% down?
Well, in this video, we're going to discuss the difference between repositioning and bridge loans, why you need them, and how they're going to help you purchase more buildings in 2023. Hey guys, Josh Findlay Ehren from the Findlay Mortgage team. In today's video, we're going to be discussing the difference between bridge loans and repositioning loans.
In today's market, our multifamily asset buyers, they're facing some unique challenges. Interest rates on the conventional side are so high right now that the only way for a buyer to get into a property is to put 40-45% down, which just isn't feasible for the average and the majority of multifamily asset buyers right now. This is where the bridge loans and the repositioning debts come into play. We want to talk about what scenarios you're going to use each of these loans and what the differences are. So starting with a bridge loan is usually a 12-month loan. It's fully open, and its job is mainly just to bridge the gap between your purchase and what in today's market is a CMHC exit. A few reasons that you would use the bridge loan: one, your closing date just can't be accommodated by the seller. So today in July 2023, it's 6 months to close on your CMHC file right now. If the seller is not going to give you a 6 month extension or the time to close in 6 months, that bridge loan is going to allow you to close with your approved CMHC lender and just initiate CMHC refinance right after closing. The bridge loan, it's going to be 12 months, interest only. It's typically on the higher side, somewhere around 9.5% to 10.5% on the interest. You're going to have some fees involved with that as well too. You may have an interest reserve. It really depends on the building and the lender and what the situation is with the building. So just kind of keep that in mind. The other option that you would use a bridge loan is if the building is in good shape and maybe you can close in time, but maybe your vacancies just aren't there. Maybe you're 50% vacant or you're 25% vacant, and you just need to fill those extra vacancies in without doing any major renovations to the building. You can use that bridge to close on the building, get those vacancies filled up, and then refinance into CMHC or your term debt on your exit financing.
Yeah, it's important to note that when you are planning your exit strategy with your mortgage agent or with your bank, that this product, it does work in tandem with the CMHC exit and the takeout option. So what we would do is we would work with our industry partners on putting together a term sheet or a commitment that would have actually both options available. So we would outline how necessarily your bridge would work and how you would transition into your CMHC debt or term debt once the project was complete or the time frame that you had to close actually was achieved. An advantage of using a bridge loan would be to be able to increase the NOI throughout the actual term of being able to submit to CMHC. You might be able to get more vacancy than you initially thought. You might be able to do some quick cosmetic cleanup of some units. You might be able to figure out that you could increase your energy efficiency in your building. There's a handful of advantages to it. Now, understanding that specifically, it does cost some capital to actually do this. Unfortunately, the time constraints right now of moving your file into CMHC is requiring most people who are purchasing to use this solution. It does increase, obviously, the cost to your bottom line of the project, but it does allow you to be able to utilize top-tier financing when purchasing your asset. Another advantage of using a bridge loan in combination with CMHC would be equity takeout restrictions. So for those who don't know, CMHC has specific capital requirements for equity takeouts. Essentially meaning if you were to refinance your building and pull out capital, you'd be restricted on using that capital specifically for the building itself or purchasing additional multifamily assets. Now, sometimes this can be challenging depending on the structure and how you're going about funding your actual project. If you, for example, you had investors or capital that you had to pay back, whether it be other secured debt on other properties or other JV partners or investors, you would have to pay back, but the restrictions around CMHC would not allow you to do that moving into CMHC. So essentially what we do is we use a bridge loan, and that bridge loan is usually around 75, possibly 80%, depending on what your CMHC equity takeout numbers look like, and that would allow you to be able to pull out that capital. That capital would be restricted much less less than what you'd normally have with CMHC federal debt. The advantage of this really is to be able to move capital around and be a little bit more flexible with your projects than what you would normally have with CMHC.
One other option you might be using a bridge loan for is depending on which lender is already on title. So maybe you had to do a construction project, or maybe you bought a building with a hard money lender just due to some circumstances of structuring, and now you're looking to exit out into CMHC. Well, CMHC's guidelines state that they can only take out approved lenders under the NHA, the form. So when we're taking a look at deals that are coming in with lenders that are not approved with CMHC, this is one other option or one other scenario that is going to require a bridge loan into an approved lender and then initiate that refinance right away. So again, on that bridge commitment, you're going to have your current bridge loan to take out, your rates and terms, but it's also going to outline all of your CMHC criteria and requirements as well, all in that same sheet. So when you get a true bridge commitment, it's going to outline your bridge loan and all your CMHC takeout financing all in the same document, so that you can see how it's going to transition and what other requirements are going to be. So again, this is where we talk about when you're getting into a project, making sure you use the appropriate type of lender to be able to have them set up for CMHC right from the get-go. If we can bridge right from the get-go, even better. If it's a construction loan, depending on your experience, that might be a situation. If you're just buying the asset, if you're borrowing private funds, or depending on the structuring or the building condition, maybe you weren't able to use one of these approved lenders. So there's a few different scenarios where this might come up, but working with your mortgage broker and having a broker that understands different types of debt and how they move and transition, it's going to make your project much more efficient, but also going to save you on some of the transitionary fees and costs as well too.
Yeah, we've seen a huge push from CMHC specifically in regards to being more strict on paying out private lenders. It was kind of hit and miss previous to July, and a bunch of new rules came into effect, and they've, I guess, tightened up their underwriting in regards to being able to pay out these types of lenders. So just keep in mind that this is something that you are going to face a challenge with the CMHC underwriters if you do have some sort of private loan or VTB on title, when you are looking to move your project out of that type of debt into more conventional CMHC debt.
Okay guys, so let's take a look at the repositioning loan. So when we're taking a look at a repositioning loan, we're usually considering an asset that's severely under-rented and needs some true work done to it, not just some lipstick and some aesthetics. We're talking about renovations, new flooring, kitchens, bathrooms, basically renovating all the units. The repositioning loan is going to give you two pieces of debt. It's going to give you your loan to purchase, which is usually around 75 to 80%, and it's also going to give you a loan to cost, which can be anywhere from 75 to 90, sometimes even 100% loan to cost, depending on the product and what you're looking to do with it. But it's going to give you two pieces of debt, which is great because it's going to help you finance your project through the entirety of it. The terms that we're looking at here for a repositioning loan can be anywhere from 12 months to 24 months, so it gives you 2 years to get that done. And again, that's usually because it's under rented. We're not dealing with vacancies. We're dealing with having to get some tenants out, which we all know isn't a quick task these days. And again, doing the renovations and any sort of construction to it, it's going to have some time with it, especially if there's permits. It's going to be interest only. Again, you're looking somewhere around 9.5% to 10.5%, depending on the lender and the loan size. You are going to have an interest reserve that's going to be on top of your down payment. Interest reserve can be anywhere from 6 months of your monthly payments to 18 months to 24 months, depending on how liquid you are, your experience with the project, how vacant is it going to be. Again, when a lender is taking a look at an interest reserve, they're really just trying to mitigate their own risk. So they understand that it's going to be transition and there's going to be vacancies in there. That interest reserve is going to help ensure that your payments are going to be made on time, and it does get kicked back towards your monthly payments.
For anybody who doesn't know, an interest reserve is prepaying all of your interest up front on closing. So something to keep in mind is that you might not have to actually have the construction capital to do the project or the renovation capital to do the project, because the lender is going to fund that. But make sure you're keeping aside that actual capital up front for closing, because it can be a significant cost to you when closing on an asset with a repositioning product.
Yes, some lenders might require you to, like one of our big lenders does want you to have about half of your renovation. So again, it does depend on the lender, but that's where, depending on what you need, we're able to find a specific lender that's going to suit your project.
Yeah, repositioning products specifically are very short-term solutions. There are advantages to using this product, but there's a few aspects of a building you want to consider when you're looking to get into this. One being vacancy on possession. These are decently expensive products, and you want to make sure that you're actually able to complete your project within the term of this loan. Ensuring that you have vacancy in a project, ensuring that you have the right team in place, and that you understand the area and what the actual takeout financing is going to look like when taking on private debt of this nature is extremely important for the success of your overall project. Specifically, most investors who are using this product right now in Ontario and out west, they're using this product to actually get their MLI points. So for any of you who don't know, there are 3 ways to get your points with MLI Select. Energy efficiency seems to be the way in which most people are looking to achieve their point distribution. You can actually utilize this type of loan to be able to fund the capital expenditure required for the increase in either your heat distribution systems, your water distribution systems, Energy Star appliances, seals, any way to be able to actually achieve your points. There are some strategic ways in which you can acquire assets and in tandem use this product to help you achieve those points maybe a little bit more efficiently than you would normally have. But most people are using this type of product in conjunction with a CMHC product to allow them to efficiently finish their project on time. Now, if we're looking at what type of lender actually provides this product to the market, we're going to be looking at something called a mortgage investment corporation. They're federally regulated financial institutions, and what they're going to do is they're going to provide products to the market that are specific to their niche. There are a handful of different players in the Canadian real estate market that offer these types of products. You want to make sure that these lenders are NHA approved, which would allow you to be able to take out with CMHC when the project is complete. These lenders are very geographically focused. They do underwrite like banks, and they will take a look deeply into your pro forma and your previous experience to ensure that you do have the ability and capital and experience to complete the project on time. Something to keep in mind when submitting to these types of lenders is just overall strength of the file. We see the gamut when it comes to submissions. We'll see people who are looking to raise all of their money and to quickly at the end of the project try to structure it in a way in which makes sense. And then we have professional investors who have GPLP structures put in place, who have either sourced their own capital or who have planned out their capital stack previous to starting the project. It's important to note that not all lenders are also built the same. So most of these types of lenders are going to want to see some sort of sophisticated structure in place when you're looking to raise capital or have capital for your project. So just keeping that in mind is it may be a private lender, although they do underwrite like banks, and they are decently strict when it comes to determining their exit strategy when the project is complete.
Yeah, guys, so in today's market, the repositioning loan is probably going to be your most common piece of debt that you're going to get. There are a select handful of properties that are probably pretty ready to go into CMHC that just might need those tenancies to be filled and not much renovations. But for the most part, say the files coming across our desk, it's going to be these repositioning loans, just given the value add and the increase in value that you get from taking that underperforming asset to a stabilized and turnkey property. So if you're looking to get into a multifamily asset and you're unsure where to start, or you're unsure on the type of building that you have and how to structure your plan and your goals moving forward with it, reach out to us. We can sit down, we can run the numbers for you, we can talk about how we would start your debt process and what type of capital stack we would start you with, and how we can transition you into your end goal, which is going to be CMHC. So give us a shout, we'll run the numbers and we'll get that set up for you.
Yeah, we really appreciate everybody tuning in today. If you did get value from this video, if you could just hit the subscribe button, hit the like button, it would really help us be able to create more content like this for you. We really appreciate it, guys. We'll talk soon.